The Debt Demolisher TV with Sophia Melone.
Hi everyone, it's Sophia Melonē, the Debt Demolisher, here to bring you the tools, tips, and tricks to help you manage your financial baggage the right way. I'm super excited about this episode of the Debt Demolisher TV because we are going to be talking about individual retirement accounts. A lot of people have questions about how to operate, how to navigate, how to maximize, and how to leverage their IRA accounts, which are individual retirement accounts. And so today, I want to share just some insight for you guys to be able to really understand what are available and even some things that may be relative to COVID-19, which you can see here on the front page of the IRS's website that can tell you a lot of details around what's available related to that. But let's talk about what we're going to be covering as it relates to the rules for traditional IRAs and how it may apply to the different types of traditional IRA accounts that may be available, which are SEP, simple IRA plan, or even the SAR-SEP. Now, these are acronyms, of course, that can be easily be Googleable, but it's basically different types of individual retirement accounts depending on if you're self-employed. So these really relate to those who are self-employed. Let's go down to the contributions. What is going to be necessary? How much can you contribute to an IRA? So if you don't know, if you aren't aware that the annual contribution limits to IRAs are established each year based on tax law. And luckily, well, not really luckily, but over the past few years, the maximum contribution rate has been the same. So since 2019 through even tax year 2020-22, with our limits is between $6,000 if you're under 50, and then $7,000 if you're above, if you need to do a catch up. So what you need to do to deduct any of your IRA contributions, there are limits, of course, that are subject to that. We can just kind of scroll through and see who qualifies and how they qualify and what the contribution limits are and how to actually determine that, because it is subject to your adjusted gross income with some limitations. So there's a lot of calculations there. So I'm not going to go through that for the most part, but you can go ahead and look through that at your own leisure. But now looking at what is your IRA contribution deductible on your tax return. Is it deductible? It depends on the type. So your IRA contributions are deductible on your tax returns if they are traditional, and of course, if it's not subject to any limitations. So if you are having a traditional IRA, that means that you have opted to take it as a pre-tax deduction from either your main payroll, your main source of payroll, or even any income that you receive. As it relates to the IRA on the Roth side, that is after tax benefits. So therefore, the Roth is not tax deductible because you have already basically taken or contributed to your IRA after tax basis. And so that means any of your growth, any of your withdrawals will be tax free as long as you are just taking your withdrawals at the date in time or at the age where it will not and cause you to incur any penalties. So if you want to set up your IRA for a spouse, how much can you contribute? It's the same. So if you're filing a joint tax return, and depending, of course, on their compensation and what they make, you are limited to whatever that limit is for the year per individual. So if it's $6,000 per person, it'll be $6,000 per person and $12,000 joint. Do you report any non-deductible IRA Roth contributions on your form 8601? The answer is no. So you should not be using any non-deductible IRAs for Roth related stuff because that is not taxable. Yes, because it's after tax income. When it comes down to your distributions, how will that work? Can you take money from your traditional IRA accounts? Yes, you can. You can take money and you can withdraw from them, but understand that you will incur a penalty. And so depending on the type of IRA that you have, if you have a traditional IRA that you've been contributing to and you've been leveraging the pre-tax basis, understand that any withdrawals that you take can be subject to income tax, meaning the year in which you withdraw it, it will be counted as income and you'll be taxed on that, as well as you will incur an additional 10% penalty for any withdrawals that you make if you do not reach the age of 59 and a half. So if you want to request the distribution check directly from your employer or from the financial institution to contribute to your self-employment plan. So this is for those of us who are self-employed and you have your IRA account. You can do that. You will need to contact your financial institution to kind of figure out how that works and what you need to do in that regard. If you withdraw money from an IRA before you're 59 and a half, what forms do you need to fill out? So regardless of your age, you will still need to report that in your 1040 form, showing the amount that was withdrawn and then showing what you took out. And if you reached it before 59 and a half, there will be a 10% penalty that will be applied unless you meet one of the criteria of the exceptions. There's several exceptions. I'm not going to run through them right now, but you can be able to go through and look at that at your own leisure. Can you deduct 10% of the additional withdrawal penalty that's incorporated, that's applied? No, you cannot. That's a penalty. You cannot deduct that later on because of the choice that you decided to make to pull from your IRA before you reach the retirement age or the qualifiable age. Will you have to pay a 10% additional penalty if you're in a divorce? I want you guys to really pay attention to this for those who may be divorcees. You can, and there is a possibility that you will be subject to that, but you just want to make sure that whatever happens, you can transfer it over. You transfer your interest over to your spouse. That has to be included inside of the divorce decree, and then you have to remove your name from that IRA either by changing the name to your former spouse, or if you do a trustee to trustee transfer, that can allow you to establish those rules and establish the spouse to be the owner of the IRA. If you are someone who wants to ask about minimum distribution, what is the requirements related to that? If you reach 70 and a half and you're ready to begin to pull from your retirement, sidebar, 70 and a half, that's a long age. That's a very late age. That's a very late age for you to have to be able to withdraw from your retirement. Just thinking about that, man, 70 and a half, it's ridiculous. My personal opinion, sidebar, I just have to share that. But if you are over 70 and a half, you want to look at what the minimum requirements are. There are tables and things that you have to calculate to figure that out. So I'm not going to go through that for the most part, but you can kind of run through the analytics or talk to a tax professional to help you with figuring out what that is. If you're over 70 and a half, will you be required to receive minimum distributions from your SEP IRA? So both business owners and employees over 70 and a half must take required minimum contributions from a SEP IRA or a simple IRA, and there's no exceptions for non-owners who have not retired. So the Secure Act has made some major changes in the required minimum distribution rules. So for those participants that are part of the plan and they reach 70 and a half, the prior rule applies for the first RMD, must be able to start pulling by April the 1st, 2020. If you ever had the question as to whether you can roll over your Roth IRAs or into a retirement plan, yes, you can do that. As you can see, you are eligible to be able to roll that over. And if you can roll over your workplace retirement plan into an IRA account, in most instances you can, but there are certain exceptions. So you cannot roll over any required minimum distributions that you have to make. You cannot roll over any loans that's treated as deferred distributions. You cannot roll over any hardship distributions, any distributions of excess contributions that's related to your earnings, any distributions that is to one of the series that's equal to substantially equal payments, any withdrawals electing out of automatic contribution arrangements, any distributions to pay for an accident, health, or life insurance, dividends on employer securities, and any S-corp allocations that's treated and deemed as distributions. There are several rules that's related to that, so make sure that you pay attention. And how long you have to roll over a distribution from a retirement plan to an IRA, you have to do it by the 60th day on which you receive the distribution. So after 60 days of receiving that distribution, you want to make sure that you get that rolled over into the respective accounts so that it doesn't count against you in terms of tax treatment or withdrawals. So there's a lot of information that I wanted to be able to show you guys as it relates to the IRA questions. Feel free to check out the IRS's website and read them through for yourself. And if you have not done so, get your IRAs and get to work.
The Debt Demolisher TV with Sophia Melone. The Debt Demolisher TV with Sophia Melone. The Debt with Sophia